Hey everybody, it's Eric. I'm back with another zero DTE trade example. Today was not easy. I'm going to tell you, it seemed like the market was bucking all the indicators and tools that I use, including the forecast, including options flow, including technical analysis. And why is that? It's because it was a news-driven day. And let's go ahead and walk through it. I'm going to show you the charts. I'm going to show you that I was actually able to squeak out a gain, but I feel like I'm pretty lucky. But I really tried to approach this like trading with a scalpel, like just really specific and just being really patient and just understanding that this is one of those days and you may not get as many trades off or trade the size you want, and that's okay. We're here to live another day. Let's talk about what was happening before the bell. Today was a jobs report, continuing jobless claims. And in case you're under a rock or something, jobless claims, jobs, jolts, anything Fed related is going to move the market if the market doesn't like the idea of the Fed being more dovish. So what do I mean by that? Well, today we had continuing jobless claims. These are how many jobless claims are coming out for this particular week. Ideally, in a real kind of normal world, ideally you'd want your jobless claims to be low. That would indicate that the economy is doing well, jobs are doing well, and that the market would applaud that. But in this environment, good news is bad news, because when the jobless claims came out and they were lower than expected, that is good news for the economy, but bad news in terms of interest rates. And since the market is a little bit more sensitive on interest rates, the Fed might be able to keep rates higher for longer, or the Fed may be able to actually raise interest rates depending on the job market. So even though we had a good jobs report or jobless claims, this is actually not good in terms of interest rates. So that's the first thing we're continuing with. As you can see, this comes out at 8:30. This is Eastern time before the bell. So an hour before the open, we know something's going to happen. And the next thing we do before the bell opens is we look at the alpha crunching forecast. Today was Thursday, September 7th. And we can see we have a clear downtrend. And what does this mean? What is this forecast telling us? This is telling us that over the last month or so, that Thursdays have typically been a bearish day from the open. That's pretty much what it's telling us. But we know when there is a jobs report or something that causes a large movement, basically causes a large gap, that the forecast is going to be less reliable. So yes, the forecast is telling us, hey, it's probably going to be bearish day. We still need to look for our entries and keep our market awareness around, but that's what we're kind of going into today. So when the market opened up, we were actually gapping down about, let's call it 30 points or so. We closed yesterday at 44.65 and we gapped down to about 44.30. So we had a 30-point move in the opening candle or opening gap. So when we look at the forecast and we say, okay, the forecast is saying typically we get a 30 or 40 point move lower. The fact that this happened right at the gap makes it kind of tricky to trade. This is why we sort of want to let the dust settle and maybe kind of see what opportunities we may have, because we very well know that the market could actually try to fill that gap over the course of a period of time. And the larger that gap is, in this case 30, 40 points, the longer it takes for that gap to get filled, if it's going to get filled. And we'll look at kind of where the market ended up today. We still got a couple hours to go, but I went ahead and took this screenshot of the trade I took. And the idea here was that as the market gapped down, we have a sell signal. I did have my trend indicator on here, the UT bot, and I'm basically looking for a retracement to sell call spreads. This is actually not August 7th, it's September 7th. So my notes are wrong there. Sorry about that. So as the market starts to rally back up, I went ahead and entered a 44.60, 40.65 call credit spread. So this line is where that strike is. It's a little bit below where the gap fill would be, but it's above 44.50. So 44.50 is one of those levels. It's a quarter strike. They tend to be magnet slash support resistance levels. So 44.25, 44.50, 44.75, these can often be resistance and support levels. So as you can see, when we rallied back up to 44.48 or so, we actually pulled back a little bit. So I was thinking of 44.50 as a slight potential resistance level, but I still know that there's still a lot of room to potentially fill that gap, or at least make an attempt to move higher. So the idea here is, yes, I want some bearish exposure, because if the market rolls over and dies, then I want to participate. I want to make some money. But at the same time, I don't want to go all in and ape into some call spreads here. So I went in with a half position. For me right now, that's about 3 contracts. When we're in this kind of uncertainty, jobs market type days, I definitely don't want to trade full size. One of the things I do, and this is a little bit different, I think, from others, is I will trade smaller size. You can see I got a credit of $1.15. So I entered on this candle. I sold this spread. I got a $1.15 credit. And so the idea here is that, yeah, I have plenty of, room for the market to wiggle. I was maybe 15, 20 points out of the money. Some people think this is close. It's okay. The idea here is, if we actually rally back up to the gap fill area, this spread is going to increase in value, and it's going to be worth maybe $2, maybe $2.50. If we actually fill the gap and both my strikes go in the money, this spread's going to be worth about $2.50. So that's okay, because what I can do is then sell additional spreads at that same price. I would sell another 3 spreads and take in $2.50 credit. So in theory, had the market gotten up there, I would be in for $1.15, and let's just call it $2.50 for math, or $2.35. So that would put us at a credit of, if we got in for $1.15 plus, let's call it $2.25, we divide that by 2. So we'd have a net credit of $1.70 per spread. So at that point, if we did retrace, a couple things that does is it raises your break even on the price level. So when you leg into the spread, when you get into that second spread for 225 or whatever it's going to be, that means that the break even level is going to be lower. So if we actually got a full retracement back to these levels, you would be in profit, whereas opposed to if you got down to 44.45 back at this level, you'd still be at a break even with the $1.15. So this is something that I've been doing. It's been working really well. I've been doing it on larger time frames as well, legging into things, because the market is so volatile that you either want to be able to adjust or roll, which I've done a little bit of that on my longer dated spreads, but it's really hard to adjust and roll 0 DTE. So I've been doing kind of the leg in thing. The downside is that I only got one position, and about, I don't know, it was less than 15 minutes later, this spread went from $1.15 down to 60 cents. That's about 50% of the max profit. I went ahead and exited the trade because that's typically what I try to pull out of the market. Is if I can pull out 50 cents per spread, then I'm good with that position. So here's the entry. I sold for $1.15 at 9.43, and my order hit at 9.56. So I was out of that trade. Let me tell you what else was going on that helped confirm or help me, sort of have a little bit of confidence that I should go ahead and enter at that time. Obviously, the forecast was bearish, as we saw, but I also used market net flow. And at that time, in that very early morning open, we did see a little bit of a spike in puts and some selling in calls. So at the moment, the market was bearish. The options market was bearish. I know that this could change pretty quickly. So again, don't want to ape into a full position or anything like that. So I went ahead and had a couple things going for me. One, I'm trading smaller because of a jobs report. The forecast is bearish. The market is gapping down bearish. So I want to still focus on the bearish side, although I don't want to chase. But I did have a little bit of confirmation here with the options market as well. So that's sort of how this trade went. I was in and out of the trade in like 15 minutes. Here's the downside. The rest of the day, I was looking to enter into another one. And let me go ahead and bring up that chart. So here is the market the rest of the day. We still have about 2 hours to go. I still may try to look for something, but at this point, when you're 2 hours before the close, it's kind of hard to get a decent credit. So it's like, is it worth it? Is it not worth it? To me, it's not worth it because I've already been sitting all day. But let me just kind of talk through what happened here. So here was my entry that I took. I was out. At this point, I'm looking for a bigger retracement to potentially short again. And the trend indicator actually went on a buy signal. And this is a 5-minute chart. So pretty much for the rest of the day, we're on this buy signal. Now, we are not you know, quite filling the gap. This, I probably could have stayed in this trade a lot longer, but I mean, just think about this. If I can get 50% of the credit in like, 13 minutes or whatever it was, it's like, why would I stay in this all day? I thought about shorting some of these spikes, but you know, it was interesting that the market itself is bucking every sort of indicator that I have. Again, look at market net flow for most of the day. We had TFC was bearish, meaning all the expirations, put options were outpacing calls. You actually had call buying and put selling, although it did level off a little bit. But even with that, the market is rallying. The VIX is up. Apple is down 3%. So to me, there's probably some sort of underlying rotation happening out of big tech into, blue chips or whatever you want to call it. But again, I didn't really get a signal, a true like sort of trend change signal to enter another trade. So I really just sat and just kind of watched. I checked in, took the dogs for a walk, did some errands. I'm about to run another errand because I just not going to wait around anymore. So I got a little bit in the front end here, but that's what I got. Hope you enjoyed the video. We'll see you in the next one.